What's happening across our industry is it's interesting to me. With interest rates being higher, you have to get a little more strategic. So if you're a seller and you want as much money up front as possible, I mean, those deals, they don't necessarily exist. Like the money is there, but if I can get 7, 8, 9, 10, 11 times cash flow or EBITDA, how long do I have to stay on for? Right. So the quicker you want to exit the business, clearly less money that you will have in cash, less money up front. So the higher the premium that you want, that you're going to have to stay on for at least 2 years, maybe 5 years, depending on the firm. I'm seeing advisors, maybe even on the younger side, right? So late 30s, early 40s, where they enjoy the business, they like the business, they don't necessarily want to be an operator. So they love the relationships. They love their clients. They like the scoreboard of bringing on new business and new assets. Maybe they're having some capacity or bandwidth issues where they can say, hey, maybe I can sell part of my business or all of my business and do an equity swap sort of an arrangement or sell to a larger entity. And they can just go on and be an advisor. And so they can get part cash up front and then exchange part of their valuation in the form of equity. And they can go out and just continue to grow their business or even go on the acquisition hunt themselves. I think that's the big question, right? So whether you're 40 or 62, 65 and looking to get out of the business, if your deal is locked up in equity, you've got to really understand what is going on at that firm. How quickly have they grown? Are we in the first or second inning and there's a lot of upside for my equity? Or am I more in the eighth or the bottom of the ninth and I'm looking for a grand slam here to win the game, which could happen. It's that Hail Mary right at the end of the game. The more established the firm, the bigger the firm, there's less upside with your equity, right? It's the same thing. Like you've got to worry about your equity being diluted. So I just think you got to do a good job of knowing the ownership structure, understanding the culture, and really, really just diving in well beyond the numbers to understand, hey, what is at stake here? When is the next exit? Right? The firm has one private equity backer. They just sold 30% of their business to acquire another private equity backer. So now I've got the firm, two PE backed companies. This feels different, right? What is the strategy? And there's just a lot of advisors that are saying, that are okay with that arrangement. But a lot of advisors say, well, hey, if I'm going to get equity, I'll just continue myself and I'll hire an associate advisor